Hi friends, now in this session we will discuss the first reading of CFA Level 2's financial statement analysis subject, the intercorporate investment. Now this intercorporate investment reading covers three different IFRSs or three different category of the IFRSs which deals with three different areas of the accountancy. For this reason, I will provide you the whole discussion in 3 or 4 different parts, mainly 3 different parts for these 3 IFRSs and then the last part maybe for the conclusion. With this, you will get a proper understanding because as a discussion, these 3 IFRSs are not as such related in the working principle, but they are related because they fall in the similar domain. Okay. So the working principle of 3 IFRS is completely different, which you will understand once we start the discussion. Also, the discussion is slightly complicated, so you have to be patient and understand the things. Now, before we begin our proper discussion, I have a very important note for the students who are going to watch my video of the FSA. And this note is only applicable for the financial statements analysis and not applicable for remaining 9 subjects. There are 2 types of students in the CFA Level 1 and Level 2. If we see from the perspective of the financial statement analysis, those who are pro in the accounting and not pro in the accounting. Okay, so pro in the accounting as in the students who are coming from the background like the chartered accountancy and the CPAs, certified public accountants, the hardcore accountancy background, maybe the ACCA can be included here. So if you are coming from these backgrounds, then my recommendation is to just read out the first 3 topics of the FSA because first 3 topics are directly covered in detail in the main accountancy curriculums. And then after the third topic, that is starting from the 4th topic, you put your proper hard work, you may watch my videos and so on. But for first 3 topics, make sure you do or prepare by yourself using the self-study. Because in my discussion, I'm going to assume the students who are coming from this background, that is a non-pro background, okay? So I will assume you are new to the accountancy or not pro in the accountancy. Maybe you are coming from the commerce background or something like that. In commerce, we have discussed the accountancy, but there is no detailed discussion on these type of standards. So there is no hardcore discussion on the IFRS. So that's why with this assumption that you know nothing about the IFRS and specifically these type of IFRS which are complicated IFRSs, I will keep this in mind and then I will give you the discussion. So if you are coming from the pro background, then you will find discussion very basic and the examples are not very professional because in my head, I am teaching the students who are not from the accountancy background. Okay. And if you are from the non-accountancy background, that is non-pro in accounting, then definitely this video is going to be very helpful for you. I'll make sure I'll simplify discussion to very basic level, which will be important for your exam also. You'll be able to tackle the exam questions, your LES questions and everything. So from that perspective, I will give. I'm not assuring that I will be highly technical. Okay, I will intentionally avoid being technical here. Otherwise, you won't understand, like, because I'm assuming you are not the pro in the accounting. So you won't understand those technicalities. So you have to avoid the technicalities. Even in general, when you are preparing the first 3 topics of financial statement analysis CFA Level 2, make sure you prepare enough for the exam and don't try to get the expertise. If you want to get the expertise, let me tell you, this whole first chapter itself will take around 30 to 35 hours. Okay, so 35 hours on just one chapter for the first preparation. So these are very big IFRSs and most complicated IFRSs if you want to get the expertise. So that's why my recommendation is don't worry about the expertise. Know the basics. As a financial analyst, you don't need the expertise of the accountancy. That's the accountant's job, right? So you have to understand what are the terminologies, and that's what we will do here. But definitely we will cover everything from the perspective of the exam, right? So we are not going to cut short the discussion or like that, right? Now let's understand what's happening in this chapter before we see the main or the first concept. When you make any investment, then you make 3 types of investment according to this chapter. Maybe you are buying few shares of a particular company for, let's say, trading purpose or for the minor investment purpose. So when you buy a minor shares, like the small amount of shares in a company, and here the small amount is less than 20%. So if you are taking this stake which is less than 20%, then we have the first category. What is the category, what is the name, and what happens inside that category? That's a separate discussion. First, let's understand what are the categories. Then there is some kind of substantial stake, okay, some kind of like the big stake, and this stake is in this range 20 to 50%. So if you are investing in a company where you buy 20 to 50% of that company's shares, then you will fall in this particular category. And then we have the situation where you buy the majority stake, that is more than 50%. When you are making the investment which is less than 20%, in general accounting terms, we call this as investment in the financial assets. This is known as the financial assets. So if you buy one share or up to 20% of that company's shares, it will be treated in exactly same manner. There is no difference in treatment. And mainly this is applicable for the companies, right? So I'm assuming you are the company. In your head, you have to imagine you are the company, or you are working as a CFO of the company and you are taking a decision. This will help you in understanding the concepts in better manner. Now here, at the 20% level, you don't have any influence or control of the company, right? It is just a minor stake in the company, and you will buy. Once you get the proper opportunity to exit, you will sell the shares and so on. Then second situation where you invest 20 to 50%, this particular situation is known as investment in the associates. Investment in associates. Now this investment and associate category is where you have some kind of influence on the company. Okay, very minor influence. You are not the controlling. You are not in the controlling position, generally speaking. But yeah, still you have some kind of influence on the company. And then last category is known as the business combination. Okay. Now, first category, financial associates. Second category is investment in the associates. And third category, the last category, is where you invest in the company where the stake is more than 50%. And here you have the control. So you can effectively decide what company does, right? So that's the controlling stake. You can call this as a situation where we have the consolidations or the business combination. So if you see the word consolidation or the business combination, for your reference, remember we are talking about the same category, okay? The same category. Now, here, the first category where your investment is less than 20%, this particular category is dealt by the IFRS 9. Okay. In India, we use the same IFRS by the name of Ind AS 109. Okay. In India, all the IFRSs will be called, if it is 9, we will call this as 109. If it is 7, we will call this as 107, like this. Remember. Okay. So IFRS 9 and Ind AS 109 is not exactly same thing, the broadly same thing. Now for the investment in the associates, we use the IAS 28, the principles of IAS 28. Now, what is this IAS? IAS is also the IFRS, but the older versions of the IFRS is called as the IAS. The newer versions are called as the IFRS. So remember, IAS, IFRS, it is coming from the same vertical, because before 2001, if I'm not wrong, for these standards, the accounting standards, we called them as IAS, and now we call them as IFRS. Okay, and for the last, the business combination part, we use the IFRS 3 and 10. Two IFRS are applicable for the business combination. Now you don't have to remember which IFRS is applicable for which situation. I'm just giving you this particular like the idea of these are three different IFRSs, right? Now when you have the investment in the financial asset, then for the accounting part, or in this particular chapter, we have to mainly focus on its methods which we use. And these methods are the amortized cost, FVTPL
FVTOCI.
Fair value through profit and loss and fair value through other comprehensive income. In some books you will also see FVPL. Okay, so fair value through P&L, but they write it as FVPL. I have a habit of saying FVTPL and FVTOCI, so I will be saying as FVTPL and FVTOCI only. But you have to remember FVTPL and FVPL is exactly same. FVTOCI and FVOCI is exactly same. Now, for this particular situation where your investment stake is 20 to 50%, we use the equity method. And for this, for the accounting purpose, and for the more than 50%, we use acquisition method. So we have to understand what are these methods, what is the purpose of the method, how it works, and so on. So in this particular part, the first part of the video, we will focus mainly on the IFRS 9, that is the investment in the associate where your control is less than 20%. In the next part, we will talk about the investment in the associates, and we will see how the equity method works and how it is different from the FVTPL, FVTOCI and the amortized cost. And then we will see the business combination and the acquisition method in the last part, right? So let's start with the first. Yeah, one important point before again we move to the main discussion. If we focus, like if we see how the 20%, less than 20% stake, 20 to 50% stake and 50% or more stake differs in influencing the company, then we can divide this into the two categories. Okay, so first is known as the influence, and then we have the control. Influence and the control. Influence as in you can influence some policies of the company. Control is you have the outright control. For example, I'm just giving these stupid examples, but just you can understand like this. Okay, so with influence, if let's say the company is a chocolate company, the company which manufactures the chocolate, you can say that we may focus, or you can just add your help in the policy making and say, okay, so chocolate bar should be smaller or bigger. This is the influence. And technically speaking, you can have the few directors, they don't have the control, but they can influence some, they can have some influence in the board meeting, right? So this is the influence situation. In the control situation, again, we will take the example of the chocolate company, the company which manufactures the chocolate. And if you have the control, you can say from like tomorrow, we will start manufacturing cars instead of chocolate. So this is the control. Okay. So there's a difference between the influence and the control, right? So when you hold the stake, which is less than 20%, there is no influence, no control. Because with 20% stake, it is not practically possible to appoint a director in the company. Okay, you can't vote for you don't have the enough stake so that you are able to appoint the director. Now with the 20 to 50% situation, where your entity, the related entity, is called as the associate of the company. In this particular situation, you will get the influence. You can have few directors in the company. Again, not the majority, but you can have the few directors in the company. And based on that, you can have some influence, but you don't have the control. Okay. And in the last case, you have the influence and also the control. So you have influence, control both in the business combination part. Okay. This is the point to remember. So maybe if you get a question where the situation is like the entity A has the influence on the entity B, but not the controlling situation, then in that particular case, you have to remember that we will be using this equity method. Again, as I said, we will discuss what is the equity method in the latter part, but for now, just remember this. Here, one more thing to understand. This less than 20%, 20 to 50% and greater than 50% is broad categorization for the understanding purpose. It is completely possible that you have 15% stake in the company, but because of the business structure or some other reasons or the contracts you have with the company, based on that, you can have the influence on the company. If you can have the influence on the company and your stake is 15%, less than 20%, in this particular case, we will still consider that particular entity as the associate, even though it is less than 15% stake in the company. It is possible that you have 25% stake in a particular entity, your sister concern, and you can't influence that company or the decisions. In that particular case, we will consider that investment as a financial asset investment. It is again possible that you have 55% stake in the company, but you don't have the influence or the control. Obviously, you will have some influence. Let's assume you don't have the control. In that particular case, we will categorize it in the investment in the associate. So for the broad understanding, you have to remember it is less than 20%, 20 to 50%, and greater than 50%. But when we call this as a percentage, but the thing is, the main thing to focus is the influence and the control. We have to check when we are doing the accounting. Again, it is not your job as an analyst, but when we are doing the accounting, you have to focus on, is there any influence? No. Is there any control? No. If this is a situation, financial asset. Is there any influence? Yes. No control, investment in the associates. Is there any influence and control? Yes. Then it is a business combination where effectively that whole company is your company. And then you will treat that particular company from this particular perspective. Okay? Fine. Now, this is the introduction, end of introduction. Now we will see the actual discussion. Here, before we begin the investment in the financial asset, understand few things. You maybe like you already understand these things. There is a concept called unrealized return. Unrealized return Now, let's assume you purchased a stock for 100 at time t0. This is the time t1. This is the balance sheet date. Remember, on this date, you are freezing your financial statements. On this particular date, you still have this particular position, but the shares are carried at 120. So the market price of the share is 120. And this is the T2. Again, this is the next balance sheet date. And on this particular day, you sold your shares for say 140. Okay. Now you purchase at 100. At T1, it is 120. Because you have the ownership, and here you sell it. Because you have the ownership, this particular, for this year, for this particular balance sheet date, this $20 increase in $20, increase in your asset value is the $20 unrealized gain. Okay? Unrealized gain, because you haven't realized it. It is like simply the increase in the share price. That's it. When we are at the T2, at this particular point, $20 is your realized gain. Remember, I'm not taking $40, I'm taking $20 because $20 is your previous year's unrealized gain. It was gain, but not realized. Here, at T2, you have again extra 20 from 120 to 140. You have $20 gain, but because you sold it, it is your now realized gain. So that's the difference between the realized gain and the unrealized gain. Next thing is the fair value. Fair value. Now, broadly speaking, in simple terms, the fair value is simply the value at which you can sell your securities or any asset. Fair value is a fairly complicated concept, and where we have the full IFRS on just the fair value measurement. Okay. Here, we are not concerned about the details and nitty-gritties of the fair value concept. You have to just understand the fair value is the value at which you should have, or you could have sold your asset, or you can sell your asset if you are planning to do it now. Now, at this particular point, because the market price of the share is $120, so this will be the fair value of the asset. In the next part, like the at T2, the price of the share is 140. So it is the fair value of the share. Okay, so fair value is for the financial analyst. Just understand, it is the price at which you can sell your asset. That's it. Okay, and this should be sufficient. Now, the first method which we are going to see here in this particular, the financial assets part, the investment in the financial asset, where you have the stake less than 20%, maybe 1 share, maybe 10 share, maybe 100,000 share. But your ownership in that particular company where you are making the investment, your stake is less than 20%. That means you don't have any influence, you don't have any control. So the first method we are going to see is the FVTPL. FVTPL. This is fair value through profit and loss. Remember, whenever you purchase any asset, that asset is recorded in the balance sheet or the P&L, mainly the balance sheet. At the balance sheet will be wrong word. I will simply say in the books. Okay. When you purchase any asset, that particular asset is recorded in your books at the cost. So when you purchase, this is the T purchase time when you are purchasing it, you carry it at, or you record it at book. Here in the FVTPL method, at every balance sheet date, you have to increase or decrease the asset's value at its fair value. Okay, so it is fair value. You have to increase the asset's value or decrease the asset's value in your books based on the market conditions or the market price of the share, assuming the security is market tradable in the market. In this particular situation, if it is tradable, then you will be carrying it at the fair value in your books. It can be profit or loss. Okay. Now let's take the same example. You purchased shares at 100 and now the price is 120. So you have to show this share in your books, in your balance sheet at 120. But here we have the gain of, let's say, dollar, not let's say, it is $20. So you have gain of $20, which is the unrealized gain. And let's also take the dividend situation where you also got the $5 dividend for this particular share in the same year. Now this $5 is your realized gain. So you have the $20 unrealized gain, $5 realized gain. Now this FVTPL says that this gain, realized and unrealized, the 20 and 5 should be going through the profit and loss. Okay, so the main P&L, it should be going through the main P&L and ultimately it will be added in your net income. Okay, so this will impact your net income, that is add in profit and loss and will become part of net income. Okay, and then this net income will go to the equity. Let's say now this shares price declines to 110, but remember this is the fair value. So fair value of the share declined to 110. Previously it was 120. Now you have the loss. So $10 unrealized loss, and let's say plus the dividend of, again we will take the dividend of 5. So here you have loss of $10 and gain of $5. So net is $5 gain. Okay, so dividend of 5, loss of 10, net is $5. Now this net $5 gain will be going through the P&L. You will add it in the P&L. And when you sell it, let's say at this particular point before the T3's balance sheet date, you sold this particular asset at 140. So now you have gain of from 110 to 140. So $30's gain, which is again, this is the realized gain. And at the same time, you again receive the $5 as a dividend. So here we will record it again in the P&L, and this will be, it will obviously exit from your balance sheet because now you don't have the ownership of these shares. And this is realized gain. Both are realized, 30 and 5, both are realized because you realized it. So you will be recording it at P&L. So in the FVTPL, fair value through profit and loss. So fair value simply means carry the asset in the balance sheet at fair value through profit and loss. This means the gains or losses will be going through the profit and loss like this. Then we have the next method, fair value through other comprehensive income. Fair value through other comprehensive income, the FVTOCI method. In the FVTOCI method, here we have only one difference. This is the time of purchase. Okay, you purchased it and you purchased it at $100. Again, record it at cost. This is your balance sheet date, first balance sheet date, T1, first year ends. And the price of the share is 120. So your gain is, I'll just note down the prices first, $110. And here you have $140. So here you have gain of $20 plus, remember we received the dividend of $5. Now here we have the typical situation where this $20 is the unrealized gain and this $5 is the realized gain, because the dividend is received, you received the cash, so it is realized. So here you have to carry the asset at the fair value only, the same thing what we saw in the FVTPL. But for the realized gain, we will add it in the P&L, $5, and in the other comprehensive income, it will be $20. Remember, both the methods will impact equity in the same manner. Your final balance sheet totally will be exactly same in both the methods. But the difference is here, you are taking whole amount to the P&L. In the FVTPL, you are taking the whole amount to the P&L. But in the FVTOCI, the realized gain goes through the P&L, but unrealized gains goes through the other comprehensive income. Remember, after your net income, you add or reduce, obviously, whatever is the situation, you adjust the other comprehensive income, and then your final total comprehensive income adjusted or goes to the equity. Okay, using this net income, you calculate the EPS. So this means whatever gain you are getting through the FVTOCI method, like if the asset is classified as the FVTOCI method, the unrealized gains are not going to impact the net income. Your EPS is going to be exactly same, but equity will have the impact. Okay, your net income is not going to get impacted if you are using the FVTOCI and you have the unrealized gains in the FVTOCI method. If you compare this with the FVTPL, if you are following the FVTPL method, in this particular case, your realized and unrealized gain both will impact the net income, and ultimately it will impact the EPS, earning per shares. This is the difference between the two. So are you impacting the net income or you are not impacting the net income? Because if it is gain, it must be added to the equity, but without impacting the net income, or after adding the or impacting the net income. That's the question. So we saw in the first case, like the price increased from 100 to 120. We got unrealized gain of 20, realized gain of $5, realized gain goes to the P&L, unrealized gain goes to the other comprehensive income. The net income will increase by $5 and equity will increase by 20 plus 5, 25. Okay. Here in the FVTPL, net income will increase by 25. Your EPS will be impacted by the 25 and equity will be impacted by the 25. At this particular point, you have the loss of $10. Again, this is unrealized loss, and $5 as in dividend. So here you will add $5 in your P&L and loss of 10 here. Okay. Loss of $10 in the other comprehensive income. In this particular part, remember we sold this at this particular point somewhere. We sold this particular asset, and this is your T3, this is your T2. At this particular point, we sold this asset for 140. So here you have $110 and 140, 30, which is your realized gain, and $5 is your dividend. Again, this is the realized gain only. Both are the realized gains. So the whole part, $35, will go to the P&L and nothing to the other comprehensive income. Fine. So this is the difference between the FVTPL and the FVTOCI. This is what you have to understand. There is a difference between the treatment in how you are treating the unrealized gain. That's the only difference between the FVTPL and the FVTOCI. Now, when can we use the FVTPL? When can we use the FVTOCI is a different thing that we will discuss later. Once, let me conclude all the methods given here, and then we will see in what situation you have to use the FVTPL, in what situation you have to use the FVTOCI, and same is for the amortized cost also. Now let's see the concept of amortized cost. Now amortized cost as a concept is fairly complicated. Okay, so understand how this concept works or looks. For this, we will start with the example. And remember, the amortized cost is only and only for the debt. You can't take equity in this amortized cost. Amortized cost is only for the debt. Let's understand the basic concept here. Let's say you purchase the particular bond, which has a fair value is equal to $1 lakh. The fair value is $1 lakh of this particular bond. And you purchased this particular bond at, let's say, $95,000. So you purchased it at $95,000 and the maturity is, say, 3 years. So at T3, at this particular point, this bond will mature. Now let's assume you are carrying this particular bond. This is your asset. Remember, you purchased the bond. This is your asset. You are carrying this particular bond at cost. Let's assume like this. And we are standing 1 day before the T3. If I ask you, what is the value of your asset, this particular bond? As per your books, it is showing $95,000, right? But we know you will get $1 lakh at the maturity. It is just tomorrow. So tomorrow you will get $1 lakh. In your books, it is showing at 95,000, assuming you are carrying it at the cost. This is problematic because you are showing the asset at 95,000, but actually you will receive 1 lakh. So what we do, we gradually or slowly increase the value of the asset till T3, so that at the maturity date, the fair value in the books is exactly what we are going to receive. That is $1 lakh. And this is the method we have to see. We have to see how it works and how it ultimately reflects in the P&L and the balance sheet. Okay, so now let's see. And the same thing can be reversed also. You purchase the asset at, say, 1,05,000, and at T3 you will get only 1 lakh. So you have to amortize the whatever the premium you paid for the purchasing this asset. Okay. So let's assume we are taking the example of the bond. So bond, the coupon price of the bond or the coupon of the bond is 10%. The yield applicable for the bond is 8%. And obviously, if the coupon is more than the yield, the bond is purchased at the premium. Time to maturity for this bond is 3 years, and we are assuming the face value is equal to $1 lakh. Okay, this is what you will receive at the end of the maturity. Now, because this bond is purchased at, this is the premium situation. So here we will see the amortization of the bond premium, and let's see how it works. You can use your financial calculator. Okay, just feed these values and you will get the final answer. The cost of the bond is the cost at which the bond is purchased. So the bond is purchased at 1,05,154. This is what you paid to purchase this particular bond. Remember this. This is what you paid. Okay. And again, your calculator will give you the same value. So feed the coupon of 10%, yield of 8%, time to maturity 3 years, face value 1 lakh. Automatically you will get the present value is equal to 1,05,000. And this is our purchase price. Because remember, in real life, you won't have you will have the reverse situation. Like you will know the purchase price, and based on that, you will calculate the yield. But here, because we need to understand the concept, I am giving you the yield first, and then based on that we are calculating the purchase price of the bond. So when you purchase this particular bond at this particular price, it will be 1,05,154, which is the present value, and this is what we are assuming, like you purchased at this particular price. Now understand how the remaining treatment works. Remember, yield is actually what you earn, 8%, right? So you earn 8% on the bond. Now you have to understand, when you are recording the income, you will always use 8% yield and whatever is your initial investment value. Remember, you invested 1,05,000. It doesn't matter whatever is the fair value of the bond. We are not concerned about it. But you invested 1,05,154 in this particular bond, and at the yield, at the return, at the gain value or gain percentage of 8%. This is how you have to think. And we will say, okay, so I invested 1,05,000 at 8% of yield, not the coupon, at 8% of yield. So this is my income which I will charge in the P&L. So 1,05,154 multiplied by 8% will be recorded in the P&L. And here it is 8412 point. It is 34, but I am ignoring the decimals for now. Okay. So this is what we have to remember. In P&L, it will be recorded at 8% of the opening value, not the purchase price. So we will see the amortization, and after amortization it will change. But for now, whatever is the opening value of your asset or the investment, at the yield percentage, you will record the P&L. Then we have the coupon, and coupon is 10%. And you will receive coupon based on coupon rate and the face value. So 10% of your face value, which is $10,000. This is 1 lakh multiplied by 10%. This is what you will actually receive. Now here we have the difference. So you received 10,000, but you recorded the income only 8,412. So what to do with this particular difference? So you actually receive more, but you show less of income. So this additional gain must be adjusted, and here we will make the adjustment, and the adjustment will be made in the opening balance of your bonds value, and this is known as the amortization. Okay. So here amortization value is simply, let's call this as A and this is B. So your C is equal to B minus A. Simply calculate the difference, whatever is the difference. It is 1,587. Okay. This is amortization of the premium because you purchase bond at premium. So you will amortize the premium. And remember, our objective is to get this particular opening value, to the 1 lakh in the third year. So we will reduce this amortization amount from this opening balance, and then you will get the closing balance. So simply 1,05,000 minus 1,587. The answer is 1,03,566. This is the closing value. This closing value is the year 1. Okay, this is the year 1. Then you have the year 2, year 1, year 2, and then we will have the year 3. So this closing value for the year, the previous year, will become the current year's opening value, that is year 2's opening value. So we'll write this same value, 1,03,566. This same value is coming here. Okay. Now again, remember, your income will be recorded at 8% of your opening value. 8% of the opening value, that is 1,03,000 multiplied by 8%. So it is 8,258. Okay, at 8%. But remember, coupon received is again 10,000. Again, you have the difference. The difference, you must adjust this particular difference because you received 10,000, you are recording only 8,258. So you have to again reduce the asset value. So the difference between the B and A is 1,714. Okay, again ignoring the decimals. So the answer here will be 1,01,851. This is the closing balance, and for the third year, 1,01,851 will become the opening. Now you will record again income at 8% of 1,01,000. So this amount is 8,148. Remember, this is 1,01,851 multiplied by the 8%. Okay, this is the amount. Again, you received the coupon of 10,000. Again, there is a difference. The difference of 1,851, and here we are again amortizing the bonds premium. And when you amortize it, now see this bond is for 1,01,851, and now we have the amortization amount of 1,851. If you see this slight difference, because from the beginning I completely ignored the decimals. Okay, so you may get the difference of $1 or $2. Don't bother about it. So finally you will have at maturity the bonds value at its face value, and this will happen at the maturity date. On the maturity date, your bond will be shown at $1 lakh, and then you will receive your cash. You will remove the asset minus 1 lakh, and then you will add it in your cash 1 lakh, because you will receive that particular face value. Fine. So this is how the amortization of the premium works. This is amortization of the premium amount. Here you have to understand few things. Because the yield was less than the coupon, bond was trading at the premium, so we were supposed to amortize the premium, slowly reduce the bond's initial purchase price to its face value till its maturity. And for this, we are simply recording the income based on our yield rate. Remember, yield is what is the income, and your investment value, whatever you invested in the beginning, that is your investment value, multiplied by your yield is your actual income, right? This is your actual income, but you received something extra, right? It is completely possible. It is not your income, but you received it. Let's say if I give you advance payment for the work you have to do next year, you received cash, but it is not your income for this year. Your income will be recorded in the next year. Right now you received cash from me. That's it, right? So this is completely fine if you receive additional cash, but your income is less. Okay. So this was the first case. Now in the second case, what we will do? We will simply reverse the situation. Let's say coupon is equal to 8% and yield is equal to 10%. And again, rest is same. The time to maturity and so on, it is same. If yield is 10% and coupon is 8%, that is you are receiving less and the yield is 10%. In this particular case, a bond will be trading at discount. So you can feed the value in your TVM function. Simply put the I by Y is equal to 10, coupon is equal to 8% of 1 lakh, whatever is the amount. Then 1 lakh is your face value, and you have to, N is equal to 3, and you will calculate the price of the bond. You will get the 95,000 approximate value. So I am taking, for the opening balance, we are assuming here that you purchased this particular bond at $95, 95,000. Okay. Same rules are applicable. Income in the P&L, profit and loss account, is recorded at the yield rate. Your yield rate here is 10%. We are taking the I by Y is equal to 10%. So it is 95,000 approximately multiplied by 10%. It will be 9,500. Okay. I took like huge approximation here. It is like the final difference in last calculation, you will see around $5-10 difference. Okay, so don't bother about it. It is for your understanding, right? Now, coupon rate is 8%. So you will get the 8% of 1 lakh. So you receive the coupon of $8,000. Now again the same rule. Amortization of discount. Here we are amortizing the discount. Amortization of discount. Difference between the income 9,500 minus the coupon 8,000. The amount is 1,500. It is actually this amortization amount is 1502. So I'm writing it as 1500 because from the starting it is not exactly 95,000. It is 95,000 something. The income is not exactly 95,000. It's 94,000 something. Okay, 988, 998 like this. And then you get the final amortization amount of 1502. But I'm taking it as 1500 directly, just to give you the clean figures. And here your closing balance will be, remember, 95,000 and we want to increase it to the 1 lakh. So you will add this amortization amount in the 95,000. So 95,000 plus 1 lakh, sorry, 1,500 is equal to 96,500. Okay. So you get the 96,500 as a closing balance. Then for the year 2, 96,500 will be your opening balance. Then 96,500 multiplied by 10% will be your income. Coupon will be exactly same. Then amortization, then you will increase the value. And then you have to repeat the same process till the T3. And this is the homework for you. Okay, this is what you have to do for the T3 and this is for T3, T2. Okay, so we got the T2 value. T1 you have, I solved it. Then you have the T2 and then you have the T3. I hope you understood how the amortization works, amortization of the premium and the amortization of the discount. Now in the amortized cost method, it is clear, like nothing is going through other comprehensive income. Whatever is the yield multiplied by your purchase value is going through the P&L. It is in totality P&L. And then you have the fair value of the bond. Maybe bond is trading in the market and the fair value is changing. So you are not bothered about whatever is happening in the real market. Okay. You are mainly concerned about what is the amortized value of the bond. And based on that, you will carry that particular asset at the amortized cost on the balance sheet date. Okay. So this is the difference between the amortized cost, FVTPL we already saw, and FVTOCI again we saw. Now the question is, what are the circumstances or in which situation we can use the FVTPL, FVTOCI and the amortized cost? So let's see this. So for the amortized cost method, this is FVTPL method and FVTOCI method. Remember, only debt, the bond or maybe the debt, okay? So only the bonds or the debt can be carried at the amortized cost. You can't have the equity in the amortized cost. Because obviously for the equity part, there is no yield and there is no coupons and so on. So obviously you won't be able to apply the amortized cost for the equity. FVTPL can be used for the debt or the equity. Okay. And then for the OCI, debt and equity. One important point here, I would have shown you how the whole thing, like the amortization, works in the pure accounting terms. I intentionally avoided giving you the idea of the accounting side of it. Otherwise, I wanted to make sure you're not getting confused in the accounting part, which is anyway not required, not the requirement of your curriculum. That's why we are ignoring the pure accounting part of it, like how the accounting entry will adjust in the amortization. Just remember, for you have to remember, you purchase at a higher price, you have to reduce it to the the face value. For that you have to reduce the amortization. That will be called as amortization of the premium. Whatever is the amount, it is simple to calculate, you understand it. In the amortization of a discount part, you purchase at a cheaper rate, you want to increase at the face value, and then you have to add the amortization. Okay, for this adding or reducing amortization, there is proper accounting. You can actually you have to pass a journal entry for that, and there is a pure accounting for that. Again, as I said, we are ignoring it because it is not required for us. Fine. Now, broadly speaking, debt equity can be recorded at FVTPL, FVTOCI. This simply means the debt can be recorded at all three methods. Equity can be recorded only in two methods, the FVTPL and the FVTOCI. If you want to use the amortized cost, then these are the conditions. your investment for that particular asset should fulfill both the test. So first is the business model test, second is the cash flow characteristics test. In the business model test, the condition is you, as a business model, you collect the contractual cash flow till maturity. So you hold the bond. If you purchase the bond, then you hold till the maturity. If this is your business model, then the business model test is fulfilled. So business model test requirement to categorize your debt investment as the amortized cost is you will purchase the bond and you will hold it till maturity. Now, just understand this. In accounting terms, when you see these type of conditions, there is no legal restriction. If you want to sell the bond tomorrow, you purchase it today and you want to sell it tomorrow, you can do it even before the maturity. No problem with that. But the initial intention should be to hold this bond till the maturity. That means you collect the contractual cash flow, that is a coupon, till the maturity. That's the business model test. Your purpose was that, like, the things didn't go well for you and that's why you had to sell it and so on, then that's a different thing. But initial intention was this, and this is your business model. Maybe if your business model is regular trading and suddenly you say, no, we are planning to do it for the contractual cash flows till maturity, then it is not a business model. But yeah, again, the business model should be like this. Fine. Your purpose is to hold the maturity, hold till the maturity. And then you have the cash flow characteristics. Your aim is to collect only principal and coupons. So from this particular investment, what you get is the principal and the coupon, nothing more, nothing less. For example, if you invest in the bond whose return or the coupon is linked to the equity market, okay, in that particular case, your purpose is not to hold the coupon. You are trying to generate the return equal to the equity market. Then the cash flow character condition is not fulfilled. And in this particular case, you can't take your debt to the amortized cost. So amortized cost can be used only if both the conditions are fulfilled. That is, first, the business model test, collect the contractual cash flow till maturity. That is simply the whole till maturity. And cash flow characteristics test is simply you have to collect only principal and the coupon committed by the bond. Okay, so this is your purpose. If you are getting anything extra or less or whatever, then it is not fulfilled. This condition is not fulfilled. Then you have to go to the FVTOCI or the FVTPL depending on the situation. And one more thing, this particular cash flow characteristics test is also known as the SPPI test, solely for the principal, and the SPPI test, solely for the purpose of principal and the interest test. Solely for the principal plus interest. Okay, that is, this was your intention or the purpose or the committed by the bond. Fine. And if your debt fulfills these two conditions, amortized cost. If your debt fails to fulfill these conditions, then we have the next methods. Now, for the FVTPL, fair value through profit and loss. If you want to categorize debt in this FVTPL, then the debt held for trading, this simply means that you purchase the bonds, you sell the bonds whenever you have the favorable price. So purchase and sell is the trading part, right? So if you hold these bonds for the trading, then you have to go through the FVTPL. Then you have all the FVTPL's characteristics will be applicable. Then you will record the bond at the fair value, whatever is the market value of that bond on the balance sheet date. Whatever example we saw, exactly like this, that particular structure will work. Or if, that is first, if you want to categorize the debt in the FVTPL first, like, is it held for trading? Yes, go ahead. Or if the amortized cost is not suitable, the using amortized cost doesn't justify the accounting treatment, then also you can use it. Fine. And for the equity, if you want to categorize equity in the FVTPL, fair value through profit and loss, then again, the held for trading if you have the equity which is not held for trading, then in that particular case, you can either go to the FVTPL, other equities, not held for trading in simple terms. You can go through the FVTPL or FVTOCI, fair value through profit and loss, and fair value through other comprehensive income. Okay. Then the derivatives, which is not for the hedging. The derivatives purpose is hedging. If you are doing it for the speculation, then FVTPL is applicable. Okay. And asset with the embedded derivative. Okay. The whole will be FVTPL. Fine. Now, for the FVTOCI, other comprehensive income method, for debt, remember, the business model test is to hold, to collect, and sell. Remember, if opportunity comes, you may sell it, but generally you will hold till collect or hold to collect. Okay, your purpose was to collect the principal and the coupons, but if you get the opportunity, you may sell it. Both the situations are possible. If this is the case with the debt, then go with the FVTOCI method. And the primary situation here is the SPPI test solely for the principal and the interest. This means the bond is paying only principal and the interest. SPPI test must be fulfilled. That is, your cash flow test must be fulfilled. Okay, SPPI is must. If SPPI test fails, the bond is like the equity linked bond, then it will be through the FVTPL. Okay, for the FVTOCI, SPPI test must be fulfilled. Remember, for the FVTPL, there is no such condition. For the FVTOCI, there is a condition. If you want to categorize bond into the the bond into the FVTOCI, then SPPI test should be fulfilled, and your business model test should be hold to collect and sell. Fine. And for the equity, if you want to categorize equity in the FVTOCI, you can do this by choice. By choice, okay? When not held for trading. It is not held for trading purely, okay? Not buying today and selling tomorrow like this. It should not be held for trading. But you can come by choice. Now, just remember this particular table as per IFRS 9. The business model test and SPPI requirement test. If you want to categorize debt in the amortized cost, it is hold to collect. Remember, hold to collect itself means the hold to collect till maturity, and SPPI test must be fulfilled. If you want to go with the FVTOCI, other comprehensive income, then for this particular part, it is hold to collect and sell. But SPPI is must. This simply means that if the SPPI test fails, that is the contractual cash flow test fails, then you have only one option, FVTPL, fair value through profit and loss. So decision, if the SPPI test is fulfilled, then the decision is amortized cost or the FVTOCI. That's it. Okay, as simple as that. And also remember, for the equity, for the equity, you will have the irrevocable choice in this other equity part we discussed here. Just a second. Yeah, in this particular part, this FVTPL and the FVTOCI, this particular choice is irrevocable. When you decide it in the beginning, that's it. Okay, so once you decided to go with the FVTPL FVTOCI, you can decide it. Okay, but if you go with the FVTOCI, you have to follow the same method. If you decide to go with the FVTPL, then you have to follow the same method. Now this was about the introduction part. Now there is very important point which is super complicated in the books, where you have the debt. Okay, and in this particular debt part, we are seeing the comparison between the how it will look in the amortized cost, how it will look in the FVTPL, how it will look in the FVTOCI. Okay, there are three different treatments for this particular part. Now in simple terms, like we saw the initial example where we saw the amortized cost example, and that amortized cost, just a second, let me check. Yeah, this one example. Okay, so you purchase the bond at 95,000. I by Y is 10%, coupon is 8%, amortization of 15,000, and closing balance is 96,500. Now how to do all these treatments? Okay, so where purchase price, I'm simply writing it here. Purchase price is 95,000. Okay, and then you have the yield is equal to 8%, and coupon is equal to 10%. Wrong. Yield is 10%, coupon is 8%. Yeah. And then time to maturity is equal to 3 years. We are not concerned about it. And the discussion is like how it will go in the amortized cost. So in amortized cost, we know if you are following the amortized cost, simply that 1500 amortization amount, remember it is 10% of 95, 10% of, just a second, the difference between the income and the difference between the income and the coupon was, that is amortization amount is equal to 1500, right? It was 1500. That is simply difference between the income you recorded and coupons received by you. That difference 1500. This 1500 difference will go to the P&L, as simple as that, recorded in the income. Very simple. So at the balance sheet maturity date, at the end of the first balance sheet maturity date, your asset will be shown at 96,500, because 95,000 plus this amortization 96,500, and in the P&L you will record 1500. Got it? It is simple. Now the question says, what if the debt is also following the FVTPL and the FVTOCI? So there are two situations. You can check that example. So debt is following the FVTPL method, how it will be recorded, and then FVTOCI method, the fair value through other comprehensive method, then how it will be recorded, how the treatments will be shown in the P&L, other comprehensive income, and the balance sheet. Simple. If you want to carry the debt at the fair value through profit and loss, so fair value is also required and amortization will also be done, because remember, you can't record the income more than like the P&L's part, right? So 8% yield, and here we have the 10% yield and the purchase price 95,000. So you have to record income at that particular level only. So here we will assume the fair value of bond on the balance sheet date is equal to, let's say, 98,000, and the objective is to show the bond at the fair value. When you are following the FVTPL method, in this particular case, in the balance sheet, you will show at 98,000, remember, because it is FVTPL, fair value through profit and loss. So you have to first carry the asset at the fair value. Then in the P&L, your realized, what is your realized gain? Remember, the difference between the 95,000 to 98,000 total dollar 3,000 is your total gain. So you had the asset worth 95,000. Now it is carried at 98,000. Okay, based on the fair value, this is your total gain. Out of which your realized gain is simply this amortization amount 1,500. And then again the difference will be same. What I will do is I will change this to 98,500. Or let's say 97,000. Okay. So your realized gain is 1,500 and unrealized gain. Remember, now at the balance sheet date, your asset is carried at 97,000. But after adjustment for the amortization, your asset is only at 96,500, right? So this 95,000 after amortization, it is 95,000 plus 1,500 is equal to 96,500. So this is the value. 96,500 is the value. So you have this particular asset at the 96,500. But you are showing this particular asset at 97,000. This 500 is your unrealized gain. This is not realized yet, right? Because this is not realized, in the P&L, you will show 1,500 as your realized gain. In P&L, it is not actually shown as a realized or unrealized. I'm just saying 1,500 realized gain is shown in the P&L, and also the 500 unrealized gain is also shown in the P&L only. Okay. When you are following the FVTOCI method, again in the balance sheet it will be shown as 97,000, but in the P&L, your amortization part, which is realized gain, will be shown in the P&L. In the other comprehensive income, 500 will be shown as the unrealized gain. And always remember, here in this particular situation, in this particular type of setup, unrealized gain is simply the difference of your final closing balance of your balance, that particular asset, after adjusting for the amortization and the fair value. Okay. This particular value, 96,500, this particular value, unrealized gain is this 96,500 and whatever is the fair value, 97,000. If it is, say, the fair value is 96,000 and in the balance sheet it is showing the after adjustment for the amortization, it is showing at 96,500, then 500 loss is your unrealized loss. This is how the treatment works. Okay. So just remember, this is the main problem for the students, how to calculate the unrealized gain here. So it is simply the fair value, whatever is given, and bond value after amortization adjustment. Okay. So these are the points you have to remember. Now, if you have any doubts, definitely feel free to ping me for the doubts. And if you get doubts, no problem. The topic is fairly complicated, so no problem with that. Okay, so that's all for the first part of the video. Thank you for watching this video. So in the next video, bye bye. Take care.